Hello, this is George Sandmann. I'm the founder and CEO of Growth Drive. And Growth Drive is a system used by business advisors to drive client profits, growth, and value. Now, we're also a community. Every week we get together to talk about all things business advisor, everything clients, cases, things we're seeing out in the world. Now, tune in here to this podcast, and you can join the conversation by scanning this QR code, passcode 867-5309. Jump into the conversation. Everyone's welcome. We're looking forward to having you. So here we go. On with the show.
George, when is the workshop going to be now? Do you have a new date for that yet?
The details of my life are inconsequential. You know, Tim, it's funny you should ask, because I just found out that they have punted my surgery to August 21st, which is a Thursday, which means I'll be able to, I'll be able to do a bunch of stuff. So I'll get that on the books stat. Also, let's crowdsource to, we have a quorum. Let's crowdsource, guys. It was suggested, so I'd love your feedback, that rather than a bunch of 2-hour blocks, we do either 2 longer blocks, 3 hours, 4 hours, or we do a full day. So I won't put my thumb on the scale.
For the workshop. You're not talking about the conference. You're talking about
No. I'm talking about the C3D workshop as promised, right? And so it's taken a little bit. Anyhow, so now that we can get it back on the books, would you prefer to have 1 full day, 2 half-ish days, or 4 2-hour blocks?
Not the 4 2-hour blocks.
Yeah, it's a nightmare to schedule. Okay, agreed.
Yeah, negative Ghost Rider on 4 2-hour blocks.
Listen, I'm not talking to you again, Garrison.
Yes, you are.
Hey, did you manage to spill coffee in your lap there, McDonald's?
The damn thing did fall apart on me.
That's what you get for getting a bucket of coffee.
No wonder I couldn't reach you guys this morning. You're busy talking to each other. As usual.
So why don't
George, what's the workshop going to be? Remind me.
What we're going to do is we are going to have a structured open mic. So imagine having the ability to discuss and to work through, the first 2 modules, the growth conversation and analyze, and then be able to talk through, ask questions, and have them answered, in a workshop-ish, in a study group setting, facilitated setting, the design and execute. And in fact, those, when we think about it, now that I say it out loud, those 2 marry up really well if we divide them into two, we'll book up to 4 hours, and it'll run as long as you guys want. So does that all make sense?
Yes, sir.
Okay.
Yeah, I guess I'm fine either with, a full day and just set aside a day, and that's Growth Drive Day, or 2 half days. And I don't know whether you do mornings or afternoons. Probably afternoons, courtesy of your West Coast crowd, right?
The West Coasties, yeah. Yes, probably afternoons, or at least starting. Yeah. So yes, Tim.
I guess I'd have slightly favor the 2 half days, because if that way it increases the chance I can attend at least one of them live. I find that my good intentions for coming back and listening to a recording wind up going about that far.
Well, and as we do with these, as we did with C3D, they will be recorded. They will be divided into logical bites, and we will offer the full transcript, a summary, and I have one other idea, but I don't know. I'm not going to make a promise before I can fulfill it. Yeah. Okay. So guys, we'll get that on the books then. Yeah. A little frustrating about that. Well, I mean, no one looks forward to oral surgery. And I'm not, but yeah, lining up my calendar with the surgeons and the anesthesiologists, August 21st. So that's a big fat punt.
Just an editorial comment.
Please.
No one looks forward to any surgery.
That, unless, well, yes, as a sign of intelligence. I hear you, man. Speaking of which, how's your healing going, Steve?
slow.
Cool. Well,
I had to reschedule a visit with my favorite surgeon due to scheduling conflict. So,
oh my gosh, I've never experienced that. The people who this practice is fantastic, and I really like them, as I'm sure you do yours. Hey, let's move on to bigger and better topics. So I'll get that on the books. Tim, thanks for asking. Steve, Mike, Joe, good morning, Joe. And is there anything you guys want to talk about this week?
A semi-related topic doesn't have to be today. It might be best when we've got the whole band together. But I know Eric had requested a few weeks back, and I agree, like a guided tour of Circle, which is quickly becoming the Enchanted Forest or the Rocky Mountain National Forest or something, because it's big. And I think a lot of us are groping around with where to start looking and how to track something down in there.
Well, you know what? Why don't we just do a quick tour? And Catherine is very busy behind the scenes. I mean, there's a lot. I mean, you guys load things in, we load things in. So I agree with you. There's a lot there.
Why don't you schedule a orientation to Circle?
Okay, let's do that. And I would say whatever you're looking for, we try to make sure we use search terms. Whatever you're looking for, use the search bar. Now, I can't always intuit what your brain is going to spit out as the topic, but we try hard. So,
Yeah, and I agree with that. But then yet last week, per our conversation, George, I was looking for that case study from Ridge, and I went into that search bar and I entered every version of that in the search bar, and it never took me to that module, which, by the way, I had been to before. I just couldn't remember where Hansel and Gretel left the breadcrumbs, but it never surfaced that. So just might be something we want to do periodically, is just to wander through, especially as it gets either appended
100%.
or summarized, right?
and
Hey,
I
George.
went in based on our conversation, Tim. I went in and added those search terms, and I just pulled it up. I just put in Ridge, and it was at the top. Mike,
Okay, good.
Would Clarice have it in ChatGPT?
Claire does not. Clarice. L'air du temps, Clarice. No, Mike. No, Claire does not have. I mean, Claire has access to the extent that there are public posts, and maybe we'll train her to go and look at the community. That is a logical thing to do, but no, she is not loaded with. I mean, we're adding hours of content every week, so hence the problem, and we have no plan to slow down. So, but AI will be very helpful. So, okay.
I have a miscellaneous comment, George,
Please.
related to AI. So I was in an AI discussion a week or so ago, and the speaker opined, or whatever the word is, that we're all familiar with the phrase, you can pick two of these three: cheaper, good, or fast.
Yeah.
But you can't pick all three.
Yes.
And the speaker, who's an AI guru, posited that phrase is not potentially, it's going out of truth. With AI, you can actually get it, or with AI done well, you can actually get it all three ways, just as a miscellaneous thought.
AI is interesting. And yesterday I recorded the business advisor hot seat with I'm having a brain cramp. Oh my God, the nicest man.
I wasn't on there.
Oh my God, this is embarrassing. All right. And that George needs to get I got a lot of sleep. He's with Talbot West, and his name is Jacob Andra. And he is so Jacob, I apologize. We had a fabulous conversation. In fact, Catherine is editing it right now, and we'll post it. And it was about AI and really thinking more strategically, and more what if about AI. And we talked about Claire and where what Claire will grow up to be. And Steve, to your point, I think one of the important things that AI is going to do for us as advisors is free up time. And as I said in the podcast, rather than having to write a draft and then proofread a draft, we may now be able, especially once you get skilled at crafting prompts, sequential prompts, more sophisticated prompts, be able to really spend our time having ideas and then proofing a good first draft that's generated by AI. What do we do with the extra time? Well, we get our butts in front of clients, right? That gives us more potentially billable hours, more hours for what's the term, Mike? Client acquisition.
On that note,
Having meaningful meetings with our strategic COIs. Mike, on that note, fire away.
still on that note, and I agree with Marcus Sheridan on this. I think that one of the worst mistakes you can make is do a first draft of anything they're writing on AI. Instead, I think you should do all subsequent drafts. And there's a lot of conversation about the neurology associated with AI use. I think the vast majority of people are approaching AI with a Google mindset. And the danger is it's better. Like, so if you ask Google questions on AI, you get better results than you do on Google. But there's a danger associated with that, which is a loss of potential cognitive efficacy on critical thinking, right? This is where the sophisticated prompting and having a strategic mind around how you use AI comes in. So like I do a ton of work on AI, but it's never, if I'm creating something, it's never where I start. I always start with that, and then I take it to AI, and then I'm starting to challenge myself to go back and forth between different versions and saying, hey, show me a version of this that's a little bit more provocative, right? And then sometimes I'm like, all right, how about a little less provocative, right? Or, I want something that's punchy. I think that you're two-level users of AI, and there are going to be a whole bunch of people that AI is faster, cheaper, and good for at a mediocre level. And then there's going to be a small percentage that are using AI to advance strategic thinking. All my work with my clients right now is hour a week minimum interacting with AI about strategic initiatives, having a conversation with it, and then in detailing and saving those conversations for further deep work offline.
Yeah, Mike, you're making a couple of fabulous points. First of all, there is no substitute as mental gymnastics and as formulating ideas. And I can show you in a moment for writing a one pager, right? Write the one pager. And the reason the one pager is so powerful is it forces us to distill. Anybody can vomit 1,000 ideas onto 5 pages. Not anybody, but that's one exercise. And if you do that, then you might use AI to refine it. But having the discipline to sit down and edit your own stuff forces one to think. And that, Mike, I don't know if that was the point you were making, but I agree with it so profoundly. And just a little peek behind the curtain, like when I write a blog post, I often think out loud into a document, and then I go through and relatively quickly hammer it into shape, highlight sections that I think are most relevant, and then I have a couple of models that know me, and then I use AI to refine it. And I always, always, always do a rewrite, and then to drive Catherine batty, I do a final edit when I've already said it's going to publish. Go ahead, Mike.
George, do you ever ask it to, like, a couple of things I learned from Marcus, right? Number one, I've now asked it when I'm shifting, say, from ChatGPT to Perplexity, right?
Yep.
I go, hey, I want you to keep everything that's really good. Here is my intended audience. I want this rewritten. I want this edited to be more attractive to them. Keep everything that's good, da-da-da-da. But I think a lot of people would be shocked at the difference between something written by a professional writer for an intended audience and something that's written in just your voice. And that's where I think the intersection needs to be.
Not sure I understand what you're saying, Mike.
Yeah, I disagree with Mike's thesis about the good, better, and cheap. I think if you know what you're doing with AI, you can have all three. And I think you're wasting your time if you don't ask ChatGPT or whichever LLM you're using to create a first draft for you. And of course, you've previously trained the GPT or whatever tool in your voice on the topic so it can create a decent first draft. And then you can, if you need to, apply your human touch to the final product. And I say that notwithstanding, I know it's been in the public recently that our brains are melting away because we're using AI too much and not exercising them. But that's a different issue. The fundamental issue is that you can actually create good content with AI.
I don't think that disagrees with my thesis. I think with the caveat that you attach to it, I didn't have those preconditions established within it. I would say that different people create different ways, right? And I say some people have different sticking points when they're trying to create content. And so I'll always need to approach it with what gets you to the ability to edit for your intended purpose. And for some people, that's going to be if they've trained AI correctly, which I seriously doubt they have in aggregate, right? But if they've trained AI correctly, if it really has captured their voice, I've got thousands of pages of content that I've uploaded. And even then, for me, the faster way is for me to do what George said, talk out an idea, see what AI does. It just works for me. But I can see if you've done that work that you talked about, I can see how, hey, I'm thinking about doing something. Give me an idea. Different people's brains work different ways. I think you are absolutely correct in where you're going with it.
Well, I would opine or observe that only a tiny percentage of people know how to train AI appropriately. And I would put I use, like everyone else on the call, use AI extensively, but I'm probably mediocre in that category. I know I've got to keep enhancing my skills.
Yeah. Well, and yeah, super interesting. It's just an interesting time, guys. And we're gonna have we have Jean-Marie Macomber has put Jacober. Sorry, thank you, Mike. Has put a webinar into the community on the ethical use of AI for this Friday. It was going to be yesterday. She moved it to Friday. Other people, Mike, are offering to do. It's a behavior that I love to see. Are offering to do classes, webinars, workshops for the community in the community, and it's caused me to start writing a very simple policy to say, hey, have at it, guys. Here are the check boxes, and giving you the ability. We will support you if you want to put on, share knowledge, tips, techniques, what have you. Have conversations, more structured conversations with the community. Does that make sense? So that's an evolution that I really love to see happen, especially when it doesn't, said the guy who's not getting enough sleep, when it doesn't require a profound amount of time from the mothership, from Catherine and I. So yes, and she is fantastic. That was an excellent introduction, Mike. Thank you. Hey, did we?
Hey, one last point on training AI. I think the best way to train AI is to give it your original content first, right? Because otherwise, you're training it off of its own version that you're then editing. Just a subtle point.
Well, and And to underscore the need to train it, it will often come back. And I just went through this a couple of weeks ago with a marketing piece where we had written something that had, a total of, I don't know how many, 20, 30 hours. And Tim, it's that white paper. And we put it through AI to change the audience. And the AI completely diluted, which then prompted me to go back and spend time fixing it. And that white paper, we're going to try to publish here this week. You're shaking your head, Tim?
I love that thing. I think it's awesome.
Well, you want to see something that's kind of, so what are we going to do with this, guys? And the DCF calculator, in fact, I have the engineers saying, we want to meet. The DCF calculation of value addition to clarity is being coded. We have it down to, and if it's okay with you, I'd love to show you just one graphic, and it's one graphic that might help you start framing your thinking about DCF. Would that be okay?
Sounds great.
Yes.
Okay, awesome. Let's share this. Let's go over here. So I cheated. I took this. I pulled this graphic. This is simply a Google Sheets graphic. So this is what I give. Oh, I've got to update it. There we go. Update. Thank you. So discounted cash flow, which is what, in rough terms, which is what Biz Equity uses as a calculation of value, which is what Capitalize uses as a calculation of value. Profit Sense overtly does a DCF. The DCF has its place. Why would Growth Drive implement DCF into its modeling and reports? And the reason is simple. DCF is of far lower importance in an M&A transaction. It is far lower, and we can talk about that at length. But we've created two additional looks at value. One is a DCF business, a calculation of business value using strategic capacity to imply company or to impute company specific risk. Okay, and I'll show you how that impacts in a moment. And then we have a more traditional model and this was done with input, help, and support from a couple of super experienced valuators. And so this is a traditional model, and it's within, it's a good model, right?
George, can you provide some insight into the difference between those two models?
Sure. In a traditional model, we are going to do a couple of things. We are going to discount. Based on industry. We're going to discount based on financial demographic, and we're going to discount based on company specific risk. And there are several places, and I wrote an article about this that I'm going to put in this week's blog article, saying the emperor has no clothes. And there are some challenges. That there's a meaningful qualitative element to a DCF valuation because a valuator is going to bring their professional opinion into the calculation. Now, that opinion is generally based on long experience. That opinion, it's like getting a diagnosis from a doctor, right? Long experience, a formal training, etc. So I don't want to dismiss it. It is a good opinion, but it is an opinion of company-specific risk. And when you see DCF valuations, for example, in litigation, you'll have one side doing a calculation that the business has so much risk as to be worthless, and the other side saying it's a lead pipe sure thing, and supporting a higher valuation. DCF is, and we call this out, we describe it very carefully. And again, hours of fine-tuning, and then vetting with you and your colleagues on describing why DCF is applicable, how it's applicable in an M&A transaction where it is definitely in the file, but not on top of the file. But then DCF is important when we think about internal transfers, the ability to service debt, insurance sufficiency, and so much more. So if you're selling to your management team and you, the business owner, the founder, the shareholder, are going to be holding the paper, you're going to be financing it, you care a lot about future cash flows, accurate projections, the ability of the business to service the debt. Same if you're gifting it to, or doing another internal transfer. Same for a variety of applications. What it really ends up being for us is just another look. These numbers down here, our market comp calculation of value, are far more important. Now, the first thing you're going to notice is that these are within horseshoes and hand grenades. Now, you're always going to get a best-in-class business from the private capital markets is essentially always, goddamn attorney, I can't have an opinion, is always going to give you your best value. Okay. And the market is going to discount that value, in this case, by $10 million, right? Based on company specific risk. Now, not company specific risk, based on strategic capacity. And so this might be the number you get in an LOI, somewhere in this area. This is the number this is the price that this business can fetch as it is currently run, given its strategic capacity. Okay. So now we have several looks at business. Strategic capacity. This happens to be strategic capacity of
so George, excuse me. So to put words in your mouth, or the strategic capacity model and the traditional model, the only difference is that you haven't built in with the traditional model. Well, let me say it the other way. With the strategic capacity model, since that number is bigger, then you've looked at the quality of the business and reduced some of the discounts that you took into account in the traditional model.
That's correct. This happens to be, now guys, this is just a graphic that, this is a for example. So the strategic capacity here is in the 50s. The strategic capacity here is in the 80s. So, I'm not comparing apples to oranges. This is just a for example to explain what's going to be coming out. And in fact, let me do this. Okay, I can't do that because I'm not in Zoom. I'm in hang on. Stop sharing. I'm just going to update give me 2 secs, guys. I'm going to update the 2 minutes. Yeah, that didn't work. Okay. I'm just going to update. I'm going to give it strategic capacity of like 54. Hey,
George.
Yes, sir.
I think the more that we can talk about strategic capacity, the more that we can have you continue to elucidate on it, the better. I just think of the conversation you and I had this morning about the fact that I've got almost no strategic capacity, right? It's just so revealing when you move past revenue. Anyways, thank you.
Sure. It's interesting. I had a conversation with one of your colleagues yesterday, Steve, up in Canada, about one of his clients. And what strategic capacity allowed us to do is to have a very quick conversation where we both knew exactly what was happening and talking about there are 3 different options in front of this business owner. He's running a $5 million business and it has a very specific, has one of 2 options in front of him. And Steve is pushing him hard to take the one that, to Steve's credit, is less good for Steve, but is much better for his client, and much, less good for Steve because Steve is suggesting that he no longer have a job with this client. Anyway, strategic capacity allows to have these conversations, as you and I did this morning, Mike, in ways that are very, very efficient and where there's clear mutual understanding of the topic at hand. Okay. Thank you, Mike. Now, what I've just done
is valuable for any size business.
Heck yes. Heck yes. Heck yes. What I've done is I've gone and changed strategic capacity here to, I think, 54. Now, what you're seeing in this graphic now is that in a traditional model, we're going to value the DCF value of 16 million. But when the company presents, imagine a business that presents with strategic capacity of 54. This is a conversation worth having because we have used a quantified company-specific risk. Now, there are a couple of other parts of the calculation that Well, we have used quantified company specific risk. Sidebar, wait until AI can sink its teeth into this to come up with a value of 15 million. So it was $1 million, $1.4 million delta between these two. And what I say in in the explanation that you'll see in the updated range of value, so this gets going to get presented in the range of value tab is that this is neither a gain nor a loss in terms of dollars. What this is indicative of is the cost of risk. Let this inform your thinking about the cost of risk. And then down here, of course, I mean, this number again and again and again, super precise, very precise. We work hard to make sure the model is incredibly accurate. And again, this bottom, market comp at current strategic capacity, this value as a transferable value, as a price one can expect in an M&A or similar transaction, is an excellent value. Both of these numbers stand up. Okay. So I'm just giving you a little vignette into what's going to happen in the range of values module, guys.
Are all four of those graphs supposedly the same business?
Those are the same business. So here's a traditional.
So George, why would the market comp number not correlate more closely with the DCF? What is DCF not factoring in that the market does, and why are those so wildly different?
Or vice versa?
Okay, so let's do a little valuation 101. When you're doing a discounted cash flow model, you have to impute future growth. Now, when you start telling the machine, and I can tell you will be able to tell the machine, and it's going to score your prediction how fast this business is going to grow. So, what is the credible? I'm emphasizing these words. What is the credible, sustainable growth that a competent outside professional would believe could be true for this business over the next 5 years? And so we're going to add that growth percentage, compound annual growth rate, or CAGR, no keg stands, is what we're going to use to predict the growth in revenues, cash, and then we're going to discount that back to today, add it all up, wrap it in a bow, and present it. Okay. That's a financial modeling. This is CFO work. And if you're looking to support a note, right, if you're going to hold the note, you're going to want, this is something that can help your analysis. We won't get into that right now. Market comp says, hey man, this business in this industry, in this financial demographic, we believe that it can predictably and sustainably grow. We have high confidence that it can predictably and sustainably grow free cash flow. And we're willing to pay a premium for it. Okay? Because we are very comfortable with the performance of this engine. Now, this is a very different analysis, a much more granular analysis. This is a due diligence style analysis of the company's future potential. I mean, I just described it. It's a very different way of arriving at a number. Then we're going to we're going to go through due diligence and say, okay, we are going to measure the risk in this business based on that risk. If there's no risk, we're not going to discount. In fact, we may pay a premium. And if there's a lot of risk, we may pass on the deal, which is why you'll see in the comments a conversation about strategic capacities element, growth capacity, goes to the predictability and sustainability of growth and plays out in this strat cap model. So you can tell we can do an hour long. We're going to do an hour long webinar on this, but these numbers, you guys don't have the benefit of the notes, but these numbers right below it, there are a bunch of notes, and I'd be happy to read them.
So what you're saying is in the market comp model, you're driven by growth drive, driven by the three dimensions of growth, right? You're not just speculating that you're going to have 7, 8, 12, 15% growth. You're quantifying that with dimension 2 and the actual measures of it. So, I mean, ahead of this, I wanted to just say, okay, but I found myself thinking back to is it the equity value planner? When you get to the bottom and there's these assumptions that you can put in, and it's like, okay, what's going to be your annual growth? And how is that any different than what you're doing in the DCF, right? So to me, my confusion or my lack of understanding at this point is how the presumption of growth is different in DCF than it is in the market comp. Because at the end of what we're using now, which is market comp, we're still saying, okay, well, it's 12, that's not reasonable. Let's go to 5. Let's go right. And you wind up showing somebody how they can achieve their equity value plan goal, right? Kind of the same way.
Yeah. Yeah.
It's been a while since I've been trained on all this, but I have been trained on all this. So if you've got not a ridiculously high growth business, but a high growth business as opposed to a stable business, then an M&A advisor would be doing a disservice to their client if they didn't consider DCF, because the market comp is just going to calculate a number based on history, when history isn't necessarily a good indicator of the future, which the DCF, assuming your growth assumptions are valid, is going to be a better indicator of the future and provide you with a higher valuation.
Steve, I think my brain kind of jumbled those two. I think so. Market comp, in terms of what someone will pay you, market comp is absolutely the measure to two. Now, if you're going to be holding the
No. I disagree.
Okay, go ahead.
Well, two different market comp works great for a stable business. Let's exaggerate. Say it's flat revenue,
Okay.
and EBITDA is not growing. So you got a number, you'll go look at the market comps, and there you are. It is what it is. But if you've got a business that's growing, then you're not taking advantage of that growth and coming up with a valuation, because you're not seeing it. And that's where, with the DCF, you can see it and take advantage of it. And you're not cheating. And of course, your predictions need to be valid and accurate and credible and all that good stuff. But nonetheless, it makes sense to take advantage of that and reflect, quote unquote, reality.
I agree. Now, may I ask you a question? What financial demographic, what revenue strata do you think that there's a break between the two models where market comp becomes actually a better predictor of price? Because DCF can be used to make an argument for price, but it is not a predictor of price. Does that make sense? And what I'm getting at is, if you have a business that's doing 5 million, going from 5 million to 10 million is not easy, right? But that's one exercise. Going from 20 million to 40 million is the same amount of growth, but is a different exercise. And we would expect, the data tells us that going from 5 to 10, to your point, we can have, and we do it in simulator, right? You think you can grow 20% a year, you put that number in here and let's plot it out. But 20% growth, if you go and look at the percentage of companies that can credibly sustain 20% compound annual growth over the next 5 years, and I'm stressing those words because a lot of CEOs don't sit down and say, wow, I can throw 20% out. Yeah, we're going to grow 20% every year. Well, when you're making $100, that's easy. When you're making 10 million, it gets more difficult. And then the higher up, the higher demographically you go, the tougher it becomes. And we see, and I know Joe is probably drawing like a madman. We're going to S curve this thing. We're going to go through cash crunches, etc. So when we talk about what can we predict is a credible and sustainable growth rate, when we start throwing 20% in there, there's a lot of debate. And in fact, you'll see in the graphic that it will rate you green, yellow, orange, and red. And when you put in 20%, we're going to say likelihood of success based on the data that you're going to be able to credibly and sustainably, that you're going to be able to sustain 20% growth for the next 5+ years is problematic. Can you do 20% next year? Yeah, but it's going to Well, I mean, the data's in. We will plateau. It becomes
I
harder and
think
harder.
we're arguing two different points, though.
Okay,
And
go ahead.
for the Main Street or lower middle market, market comp and SDE is more conventional valuation. As you get above lower middle market, and there's no magic dividing line, whether it's 5 million or 6 million or 7 million, then the typical M&A advisor would look at both market comps. I mean, there's three primary ways to value a business: the asset method, the income method, and the market method. And most of the time, asset doesn't come into play.
Yep.
So it's for the larger businesses and where that dividing line is debatable, and then there is no precise dividing line, then it's appropriate to do both market comp and income to come up with your valuation. And you need to have, same as when you're dealing with AI or anything else, you need to have human judgment. Is that business that we're talking about, is a 20% growth rate realistic for this particular business? Maybe in general, 20% is not, but for this particular business, maybe it is. And if it is, then you need to give it credit. That's all I'm saying.
I agree. And if I'm the acquirer, I am going to be, the acquirer has, if it's a professional investor, let's take a peg, they are going to have a rate of return, an acceptable rate of return, a target rate of return, and they're going to look to DCF as part of their analysis as to whether they anticipate getting their rate of return. So, I mean, and that, you're getting into the reason that we will put a DCF out there, and I'm looking forward to your feedback, especially, I mean, Steve, you're an investment banker. You have all of the skills of a fractional CFO. You're an exit planner, and you understand growth. You're bringing this powerful bundle to the table. So I love your comments. Thank you. And I'm looking forward, as always. I mean, we talked this weekend. I will look forward to and probably incorporate, as I do with everyone, your thoughts, your suggestions, and feedback. When this thing goes out there, 100%.
Well,
it's fun, right? Let's take another look at value. We can't talk about supporting transactions without having this other look at value. Hey, Mike.
Hey, that exchange between you and Steve was incredibly valuable, and I deeply appreciate you guys going there.
Our pleasure. Geeking out is what this community does. Thanks, Mike. I appreciate it. And one thing that just came out of this call is I'm looking at it and I'm saying to myself, well, heck, market comp is actually the time. I'm going to flip that chart around. Market comp, so high strategic capacity, current strategic capacity, the impact of strategic capacity. Then we'll go strat cap, DCF model, traditional DCF model, and then the impact of strategic capacity on those two. And it has the notes, guys. Let me give you a preview of the type of notes. So here's DCF traditional model. And the note next to it on the range of values page will read something like this. The current value of future cash flows is one important consideration for leaders analyzing debt. Debt can provide funds for growth and for exits, including internal transfers and MBOs. A traditional model can help such analysis. See, that sentence has got to go. Duh. See, this is what happens when you write things at 11 o'clock at night. During planning, consult a competent financial professional on these matters. The 5-year compound annual growth rate impacts DCF calculations. What I'm really trying to say is don't get really aggressive here unless you're highly confident, high strategic capacity. With higher compound annual growth rates inflating current value and or elevating estimates of debt service capabilities. So don't buy your own BS. A traditional model can also support insurance sufficiency analysis. And that's one of 1, 2, 3, 4, 5, 6, 7 notes. So that's the type of note that you're going to see on the dashboard. And then, of course, that you will see in an updated value You'll see this play out in reports.
And I like that you're adding DCF to that example. There's a question I have. Is there a point at which improving strategic capacity would align DCF and market? Like, is there a point where the virtues of heeding and paying attention and worshiping the increase in strategic capacity would bring those two together instead of such wide disparity?
So that's a fascinating question, Tim. Now, strategic capacity itself is largely within the control of the senior leadership team, right? It is theirs to
Right.
design and implement increases in strategic capacity. Now, when we calculate now market forces obviously act on the business from outside, and those are accounted for through several of the growth driving objectives. In DCF, we're looking at several other factors: inflation, credible compound annual growth rate. There are some other external factors. There are several external factors that come into that calculation. So, we kind of have to take that under advisement. I would say if they ever align exactly, it'd be by coincidence.
Yeah, I don't mean exactly, but I mean closer. Like if I'm looking to be on the giving side of a transaction, or getting maybe is a better way to put it, I'd like to take that to my M&A guy, and he can't screw it up with either approach, right? So I want my company to be as valuable as possible, regardless of how you go about calculating it. So it seems to me that strategic capacity has profound impact no matter which approach you take.
You're absolutely right. And I'll read you one other note. Steve, go ahead, man.
I was just going to jump in and make another comment. Especially market that's just math. Now, there's a little bit of there's more than math associated. Well, it's still math with the income method with DCF, but there's more that goes into the math. But a typical, say, a Main Street business broker, they all do valuations, and for Main Street.
Or Main Street, yeah. And Steve, can we just, for the uninitiated, Main Street, we're referring to businesses, rough numbers, $1 million and less, or even up to 2 million, but Main Street businesses.
But so the average, without the addition of and knowledge of strategic capacity, I could get P&Ls and do a valuation and market comp on a Main Street business and come up with let's say a good number, not a favorable number to the business owner. I don't mean a qualitatively good number, but just doing math. But if the business has a strategic capacity of 20, forget the math, because the value of the business is really zero.
Well, that's Steve. You just said, I am not used to not having this in Zoom. You just shared that's the key. DCF, you could have a business with strategic capacity of, let's say, 45. It may be generating cash, and it may be going along, and it may even be growing by dint of sheer force of will, of hard work.
The owner's working 100 hours a week, right?
Yeah, in spite of itself. Now one has to ask, how sustainable is that? How credible is? And we run into this with clients all the time, right? Oh, you're going to double in 5 years. How are you going to do that? Well, I guess we'll have to work harder. We'll have to work smarter. But those are both part of the answer. So what DCF does not talk about is transferability. It does not look at value capacity.
Well, market comp doesn't look at transferability either, or especially, I'll say.
Market comp looks at transferability when one takes the top multiple and says, all right, well, what are the odds that you're going to be able to get the top multiple? What are the odds that you're even going to be able to get to the deal table? Or is this going to be you getting an LOI? We'll use this example, an LOI for 18 million and getting all happy and already counting your money, and then having your teeth kicked in, as Steve, right? Tell me if I'm wrong, as so often happens in due diligence, it becomes this death struggle, which can be unsuccessful for a variety of reasons, right? But if you don't have the strategic capacity, getting that 18 million, successfully completing the sale at all, and successfully completing the sale at a top multiple, without strategic capacity, you're just not going to You're not going to get there unless there are strategic, synergistic reasons for the deal getting pushed through. Right? But if we're simply talking about a business's ability to predictably and sustainably grow free cash flow, that goes into price.
Yeah, well, I guess what I'm arguing is I'm complimenting you, this community, because the majority of especially Main Street business owners and probably not owners, but brokers, and probably a good percentage of M&A advisors don't know and never heard of strategic capacity.
That's right.
And so we're bringing something else to the table to make us better at helping business owners be realistic about what they actually have in terms of an asset.
Heck yes. And Steve, maybe we'll close on this. If I'm looking at buying a Main Street, we were just in a pizza joint the other night. It's a new pizza joint here in town. It's crushing it. And I did some rough math, literally back of the napkin. Sid says, how much do you think they're making a year here? And I asked our staff person how many pies they were doing a day. And then I looked at the menu, did some quick math, figured in a few glasses of wine, and I did some rough numbers. And they're cranking along at, I'm guessing, very educated guess, gross 1.8. Okay. Now, if somebody goes to buy that pizza joint, it's not going to be private equity. It's going to be someone who says, hey, that looks like a good job. Or they're going to buy a mechanics shop or the local Jiffy Lube. That looks like a job at which I can make good money and I can own the business. And when I'm done, I can sell it or close it. That is very different. That is very different psychology than I want to go out. I have a lot of money and I want to purchase top performing assets that are going to help this money become more money. Is a professional. Those private capital markets are looking for investment grade assets, and strategic capacity identifies investment grade assets better than any metric currently in common use, would be my argument. And I'm getting pretty muscular at making that argument.
Amen.
So, amen, man. Guys, what a fun conversation. I can't believe we just hammered through an hour. I didn't feel like it. I looked up, I'm like, shoot, more. We can pick this up and ask me anything tomorrow. I'd be like, what the heck are you talking about with DCF? But kids, it is coming live to software near you. I'm going to jump on with the engineers right this moment to talk through this
Quick
exact
question, George. I'm going to miss
Yeah, man.
AMA tomorrow because I've got a client meeting out
Good
of
for
town.
you.
But I have a quick question. When you were reflecting on the white paper, you said at one point that you'd already had Gamma turn it into a deck and then narrate it. Is that all?
I had, yeah. In fact, I have to go in. I had Claire turn it into a deck and narrate it and add music. And Claire, they say it'll take 24 to 48 hours. And unless I'm mistaken, Claire has not done her homework. So I'll go and find it and then I'll post it in whatever format and I'll share the prompt.
I'd love to see the finished product and then what the prompt or the process was. Is Claire already available for us to tap or
man.
no?
So I just renamed the Growth Drive GPT Claire.
Yeah, saw that. So she's ready to work. If I had a document or a course content or something like that, and I wanted to follow that same process, I could use that. I could use a similar prompt. Cool.
Yeah, and you can do it if it's not Growth Drive related. If you don't want to heavily lean on Growth Drive's methodology and process language, then I would do it in Chat 4.0. And if you want Claire, I mean that's an OpenAI GPT, but that's been trained to talk about strategic capacity, the 3 dimensions of growth, our process, and more. So
the prompts are in there for it. That's the piece that I will
put. So let me go and I will go and get it now, Tim. And I will post it in whatever form, assuming she's done her homework now. And it's a massive amount of computing. So what they do is they do that, I think, in off hours while we're all sleeping. Cool?
All right, cool beans. Thank you.
Guys, what a conversation. Thank you. Super grateful. And for everyone who missed it, you're coming next week. We do it every week. All right, man. Thanks, guys. I'll see you tomorrow on AMA. If I can help in any way, we are here. Okay?
All right.
Thank you.
Adios.
Bye.
This episode is brought to you by the Growth Drive Summit. Our theme this year is building a profitable advisory business. Join us in Charleston, South Carolina, October 6th, 7th, and 8th. Expand your network, learn new skills, and generally have a good time. This is a top-rated event. We're looking forward to seeing you there. Thank you.